I actually don't know if the banks want to hide this strategy. I think, to be honest, it's more like they don't make an effort to teach anybody, including their own employees, how their financial products work. But I remember a long time ago, someone asked in the comments, like, "Do the banks know about this strategy, or do the banks know that you're doing this?" And I answered, like, "Hey, like, they have all the data in the world," right? But I honestly think if pretty much the entire, let's say, banking clientele pool decided that they're going to pay off all their debts early, and there was an easy way to do it, I think that's when they would start to get nervous. But I think for now, they're not really trying to hide the strategy. It's just me clickbaiting you all. But I like this Google Gemini generated cartoon. Keep customers paying longer. Secret knowledge. Keep away. Oh no, just stick to our 30-year standard plan. Trust us. Is there a better way to pay off my mortgage faster? All right, well, let's get to it. Let's pay off all of our debts using something called, let me zoom in here, the velocity method. Okay, so what are we doing today? We're going to go ahead and pay off debts using something called velocity method. And what's the first step to it? It's basically creating a budget, because your budget is your debt attack plan. So you have your income, expenses, leftover checking and savings, and then your expense breakdown. You list every single debt that you have, right? And then on top of that, you have your personal expenses, and say it's $2,000 a month on average. Now, the difference between these and this line item is that the personal expenses are things you always have to pay for, even if you were debt free: food, gas, insurance, and all that other stuff. So what we're trying to do is determine, hey, if we were debt free, we got rid of all of our debts, would our life be much better, right? And if the answer to that is no, you don't necessarily have a debt problem, you have more of an income problem, right? That's what kind of Dave Ramsey says. Okay. So what we're going to do is, with this velocity method, we assume we have the same income, the same expenses, the same debt. I'm going to go ahead and copy and paste, right? And we're going to do something that's completely discouraged from the banking system, right? And you know what that is? Saving money. Okay. We're not going to save money. So this is like a two-step formula, which is we don't save money. So that's why checking and saving is zero. And then we dump all of our money into something called a line of credit. And if you don't know what a line of credit is, basically a financial tool where you could borrow money, pay back, and then use it over and over again, right? So there's two types of lines of credit that are accessible to the general public. One is a personal line of credit, and then the other one is a home equity line of credit. And actually, there's another one, if you're a business owner, a business line of credit. Okay. So, home equity line of credit or personal line of credit are usually easier to get. And then with business lines of credit, you can get those if you have a business. But I think there are there more homeowners than business owners? Actually, I don't know. Okay. I'd have to I'd have to think about that. But anyways, all right. So now what we're gonna do is we're gonna assume we have a home equity line of credit at 8%, 35 grand. Because we are a homeowner right here, we got a mortgage, and we're gonna assume we have the appropriate amount of equity in order to get that line of credit. And the line of credit is the only financial tool where you could put all of your money in and then get it out like the next microsecond after, right? Immediately. It is so flexible, even more flexible than a credit card, even though a credit card technically counts as a line of credit. Um, i- we use this as a debt consolidation tool so that we can increase our cash flow. And if you don't know what I mean by that, I'm going to show you a little bit later. Now, here's the secret about getting a line of credit. Okay. I'm going to tell you the ultimate secret that the bank will never tell you. So, banking is a risk mitigation institution, right? Meaning that they don't like to take really risky bets. In fact, if a bank ever took a really risky bet, the bank president would actually go to jail. I don't know if you knew that or not. In fact, there was a Midwest banking CEO goes to jail for crypto. So there was a dude, I think in Kansas, who actually went to prison for 24 years because he fell victim to a pig butchering crypto scheme and sent $47.1 million of the bank's funds to overseas crypto scheme. Like, that's why this guy went to jail for 24 years, because a bank isn't supposed to make incredibly risky bets, right? So this is the exception, but as a general rule, they don't lend money to people who need it, because people who don't need money are low risk bets, right? It's kind of one way you have to think about it. And I've explained other ways too. Now you might be thinking, well, if you're $5,500 of income with $485 left over, then that means you're in a lot of debt and you probably do need the money, right? So the bank would never actually lend you this in this situation. Now, why do I demonstrate that, with a free and clear line of credit, how you would pay off debt? It's because it's actually much easier to understand the concept with this unrealistic assumption. If you actually look at a realistic scenario, and let me just kind of pull one up here, give me one moment. Like, for example, this one right here, where you have $5,400 of income, $5,400 expenses, and $4.10 left over in 22 debts and a maxed out line of credit. We'll be here forever, or actually 1 hour and 30 minutes. So just because something is realistic doesn't mean it's actually easy to understand, right? And look at all this. Okay, so what we're gonna do is, with this unrealistic assumption, show how powerful a line of credit is. And in fact, I know that some of you are listening to me, because I just recently got this comment. Yeah, this one right here. Thank you so much for this channel. Because of you, I did get a HELOC before I needed it. Right? So people are listening. People are getting lines of credit before we need it. But if you ever go to a bank and you need a line of credit and you need money, they're going to say no. But anyways, all right. So let's just assume we have a free and clear line of credit. And what we're going to do is use something called the cash flow index, right? So what is the cash flow index? Just the formula of the balance of the debt divided by the monthly payment, right? So we have this, and then basically think this as a sorting or ranking system. So the lower the number, especially below 50, you want to pay off first. And then obviously this big number you want to pay off last. Now, why do you want to pay off this big number last? It's because, let me scroll in here, I literally have to give someone $265,000 for $1,200 of cash flow. $265,000 to pay it off for only $1,200 of cash flow. Whereas if I pay these three off, I'm going to get more bang for my buck, right? So that's about $28K for almost maybe $800 of cash flow, I think. So would I pay $265,000 for $1,200, or about $28K for about, I don't know, $800 or so? I'd rather pay off the credit cards, right? So that's what these numbers mean, just bang for your buck in terms of cash flow. And what we're going to do is, this is going to be 5, 8, 15, and I'm going to go ahead and sum it up. So that's $28,000 of credit card debt. Now we're just simply doing a balance transfer. Right? Now what happens here? Well, just by simply transferring the debt, don't these payments just go to zero? And then look at this, okay? Aren't we going from $489.79 to an extra $1,000 of cash flow? Or was it extra? Yeah, almost an extra $1,000 of cash flow without making more income, because you see the income is the same, but the expenses are just kind of, we're just doing some tricky accounting, right? We're just shuffling some of our debts, and we now turn $485 to $1,400. Okay. And then the final step of this method is, we have to put all our money into a line of credit. So when we get our paycheck, it comes to our checking account. And then after it comes to our checking account, immediately we'll put it into a line of credit. And then when we need to take our expenses, it comes from the line of credit to checking account. And then we pay our expenses, whether it's our credit card bills or our loans, right? Or any other debts that we have. And then after every single month, the balance should go down by about $1,400. And so if you want to know how to model this, it's relatively simple. It's 8th grade, or maybe probably 5th grade math, 1048.29. So you take the previous month's balance interest minus the cash flow, and then see after every single month, right, the balance goes down. But, I know what you're thinking. Wait a minute, isn't there an interest rate here? Yeah, you can calculate that. It's really easy, okay? All you got to do is take the average daily balance. You could just estimate it using this average function, multiply by the interest rate, and then divide by 12. Okay, and then what you're going to do is you're going to copy and paste, and then what we're going to see here is that in 22 months, all right, 22 months, it's pretty much all paid off. Okay, so this would be 22 months, 28K. All right, and then now we got the auto loan and the mortgage. So this is a relatively simple situation. You know, if you have 5 debts, that's actually really relatively simple to me. But again, I have seen 22 debts. I did the demonstration. If you want to see this, be a member of the YouTube channel. 99 cents, right? You know, you should see at least 2 scenarios that I went over in that live stream, paid membership, where one of them was like 15 debts and the other one was like 22. I think I considered the 15 debt one like the masters of debt payoff, and then like the 22 debt scenarios like the PhD, right? Anyways, all right. So now this is what we're gonna do is we have this loan calculator right here, and actually I gotta hide this student loan. Let me just go hide this one right now. Hide. This is from another demonstration, and then we did all right. So our loan's about 22K. So let me redo this one too. So if you want to know how I determine what the loan balance is, we got this nifty loan calculator right here. And then this is going to be months, was it 22? Yeah, was it 22? Yeah, 22. Okay, so now, all right, we have this cash flow index. So basically, we just follow the same principle. The lower the number, that's the one we want to pay off, especially lower than 50, okay? Whereas with this high number, this means that if I move this into a line of credit, I'm getting an itty bitty amount of cash flow, not recommended. Okay. Now let's go ahead. And so a lot of times people, when they look at this, they're just looking at the interest rate and thinking, OMG, interest rate, I should focus on the mortgage. Okay. Let's just go and put this debt into a line of credit and get that $400 of cash flow, because it's a relatively high cash flow compared to the debt amount. And then we're going to do this. So it'd be plus 14313.31. And then we got to increase the cash flow. So this is going to go up by 800. Holy crap. Is it $826.56? You know what? Maybe I screwed up. Oh, I did screw up. Okay. I was like, so something go wrong, but it's okay. I can easily fix this. All right. So now, dang, our cash flow is 1,800. This is better than I expected. Don't you love it when the demonstrations, when you screw up and then you thought you're going to have a worse. I've had this happen to me before where I was like talking to people and it was like, oh, your situation's, it takes about 4 years. And then like, upon revising the numbers, it realized they screwed up and it turns out it's going to be better. All right, so 17 months. Right? So let me just do this again. 17 months and 28K. All right, so now in month 17, what's the current balance? All right, so now this is about 40. So yes, we can move this into a line of credit. Should be fine. Anything under 50 should be fine. All right, so now let's go ahead and do this. All right, so plus 16097.54. And then this is going to be 0. So now we have $2,000 of cash flow. Okay, so let's go ahead and do that. Minus 2234.85. All right, so now let's see how long it takes for us to, whoopsie, I screwed up, didn't I? All right, now this is going to be gone in 24 months, okay? And look at the interest that we paid, right? Look how small it seems, less than even $100 per month, okay? So let me go ahead and put this 24 months, and then it'd be 28 plus 22, and be 50K, all right? And then in 24 months, okay, and then so now $265,000 original balance. We probably paid a lot of interest. It's the first 2 years, mostly interest, 20 grand of interest. How much did we shave off? We shaved off about like 10 grand. Okay, so now it's time for us to attack the mortgage. And there's 2 ways to attack the mortgage. Number 1 is extra payments, and then number 2 is that we can still use a HELOC, okay? I'm just gonna tell you that the thing that you can really screw up with this is to move your entire loan into a HELOC. Why? Because if you just kind of look at this, 50-foot sky level bird's eye view explanation, what does this cash flow index number mean? It means I'm moving this $255,000 4% loan into an 8% line of credit, and I'm only getting itty bitty amount of cash flow. And because I'm only getting an itty bitty amount of cash flow, then I have this huge balance that's being cooked up at 4% or 8%. I'm sorry, if you move it into a line of credit. So the lower the number, that the interest rate is relatively negligible, but the higher the number, it's actually not, which is why you don't want to replace your loan with the line of credit. Okay, so let me just kind of go in here, and what's the current balance of all of this? Let me see here. So this is going to be 265,000, 255,476.38, 255,476.38. Okay. And then is this the right income and expenses? $5,500 and $2,000. 55. Okay. So here, even if we use an 8% line of credit to pay it off, if we do it in small pieces or chunks, and we'll say it's $6,000 chunks, then it only takes us 7.1 years to pay off, and it's 39 grand of interest. Now, let me show you this. When you move the whole loan into the line of credit, that's 100 grand of interest, okay? So I'll show you something crazier, right? So let's do $6,000 at even 30%. That's less than the whole loan, moving the whole loan into a line of credit at 8% interest, right? Like the 8% interest is literally double this. And so, yeah. All right, so now 7.1 years, okay, 7.1 years, and then this would be, it's gonna be 0, and it's gonna be 24 divided by 12 plus 7.1, that's gonna be 9.1 years, and we're debt-free, okay? Debt-free, we are debt-free. All right, so what do y'all think? You think if everybody knew about how easy debt payoff is, you think the bank would get a little bit nervous? I'll ask and pin that as a comment on this video, okay? All right, well, have a great day, everybody, and I'll see you on the next one.